All right. So we'll continue with our session on how to proceed with this project. Which, remember that from Monday you have to start your project. This is one of your tickers, LVS. So we'll just continue with the discussion. I'll just once again, I will try to anchor you in where exactly we are so that you don't get confused and it does not appear as if we are just covering a whole bunch of things, in a haphazard manner. So let's look at this. So we are going through all the decision problems, and we will. So we were going to go through all the decision problems that you have to go through in order to execute this project. Right. So all these the first three problems, I have already solved for you. And then we are mainly focusing on problems 4 to 7. And we were discussing problem number 4, and we had also we had also discussed 6.2. So this is how we are proceeding. We are discussing some of these problems and some of the some of the principles and the theoretical frameworks required to help you solve these problems in an analytically rigorous manner, rather than just doing it arbitrarily. So that's where we are, and we were working on this as we were working on DP4 solutions. We had gone through that FA and TA, so we were basically at this FA-TA. We were discussing FA and TA, so we were looking at this framework. We can open this framework once again. So this is an important framework. Understanding the difference between FA and TA. And as we were, so there are 4 points to discuss here. And as we had gone into the second point, which is cyclical movement of market prices, the very important point. So as we had gone in there, we had gone into a separate discussion note on, so as here I'm looking at the DP4 solution sheet. So if anybody can't see, let me know. Just as a test, I'm now looking at the DP4 solutions note. So here we have, I'm just looking for the hyperlink for this one. Okay, so this is where we were, and I think we have already this. We already have this opened up. All right, so this is where we were. We discussed this topic, this subtopic, and we looked importantly at this. Okay, so where we were is basically, let me once again recap quickly. So we were looking at the solutions to the DP4 problem. That is, when you look at a chart, like say LVS, if you want to look at LVS, then as you look at this, how do you decide whether to buy or to sell? 2 time frames I gave you were 1 year and 3 months. Okay, and so essentially this, when you look at a chart like this, how do you decide whether to buy or to sell? And the basic, as we say here, let's open up this. We were discussing this. Let me just set the context once again from the very beginning, and let me look at the calc file here. And so obviously, as you look at the broad question of the DP4, I'm just telling you how we came to this question of FA versus TA. As you look at the broad question of DP4, that is whether to buy or sell, we discussed this important idea, this conceptual framework, where you look at 2 broad approaches. One is where you compare value versus price, okay, which is what you guys are already familiar with, and this is where your FA is located. And on the other hand, TA is located completely on the other side, where you don't concern yourself with value at all. Okay, you only look at price, pure price-based analysis. So these are the 2 broad approaches. So obviously these 2 are very different from each other. And so, and under that, we discussed a little bit about FA, and then we came on to TA. And now what we are trying to do is we are trying to give you a little bit of, as we discuss this, then we start discussing the differences between FA and TA, because we have to address the question of how do you choose between FA and TA, which is what Utsav had mentioned as one of the important decision problems that you will have to solve. And we had called it a sub-decision problem, a sub-decision problem under DP4. We had kept it not as a high-level decision problem, but under DP4 you have the other problem of how do you decide between FA and TA. And that's how we came to a discussion of the differences between FA and TA. And we were discussing these important differences. The second difference is very important. So we had gone into a long discussion of that. And as we finished that discussion of cyclicality, we came to the end where we looked at, as we looked at these 2 points, the conditions, okay, the definitions of uptrends and downtrends, very important. Please make sure these are very basic things actually, but everyone should be completely, they should have completely internalized this, these ideas, okay? They're very basic, but because these are new ideas for you, I want to make sure that everybody, just because it's basic, we don't sort of underestimate this problem. I just want to make sure that everybody understands these things very well, okay? So, all right, okay. So now what we're doing is, so therefore we were looking at these 2 problems. Uptrends and downtrends can be these 2 properties of cycles, and uptrends and downtrends is specifically defined. And the 5th one is the minimum conditions for starting and maintaining uptrends and downtrends. Okay, I'm not going to repeat it because now you have the videos and we already discussed this in the last class. So where we were was, once we understand these points, we are able to now see certain implications for okay, all right. So we have certain implications for the DP4 solutions. Okay, there's we already discussed this, that once you understand these 2 important principles, what is the definition of an uptrend and a definition of a downtrend? Here you have an uptrend because low, higher low, higher low, high, higher high, and this is actually higher than this. The last one is higher than this. So higher highs, higher lows, and the reverse for downtrends. Okay, and so these definitions, and then you have the question of minimum conditions. All right, 2 distinct highs, 2 distinct lows here, all these things. And so we discussed the implications for buy sell. As soon as there's an uptrend, the momentum trader will want to go long. So we are trying to explain some of what we are trying to do at this stage is to construct a very, very simple TA-based trading system. What a trading system is basically a set of rules that will help you to solve all these problems. And we started out by looking at this problem, and we talked about how a momentum trader might be able to solve this problem. How a momentum trader may be able to solve the problem of DP4 using the basic ideas of starting and maintaining uptrends. Okay. So you look at the starting uptrend condition, 2 highs, 2 lows, following this pattern, 2 highs and 2 lows. And with that itself, assuming that you're a momentum trader, you can immediately solve the buy-sell decision problem. That's one thing we discussed. And then we also discussed, when you look at the conditions for maintaining uptrends and downtrends, we also discussed how the idea of neutralization of a trend. Okay, please remember these ideas. These are very important, as I said. So all these ideas, that what is an uptrend technically, what is a downtrend, and then you have the idea of the neutralization of the uptrend and downtrend. So if you look at I was looking at an interesting chart the other day, okay, which is not in your notes actually, but you can see Procter & Gamble. So when you go to the supermarket, you can remember the stock. As you can see here, if so Procter & Gamble actually has been doing quite well. All right, it's it's going to all-time highs, you see. So you see here, if you even here you can see uptrend, higher highs, higher lows. So these things, make sure I'm just kind of spending a lot of time on these very, very basic things, but I want to make sure that everybody is able to completely internalize these ideas so that they become second nature to you. You don't even have to think about it. Now, every time you look at a chart, you start looking at all these things. And then you look at the maintenance of the uptrend and downtrend. And as you zoom in here, you can see this last part. You look at, this is the last low that you saw on the earlier chart. Now you see this. And then if you zoom in with 3 months, you will see here that, okay, so from here it's been going up. We can focus on the last part here. You can see, if you go up a little bit, once again, the idea of the neutralization of the uptrend. And once again, you can see that, well, it's been going up so far, higher highs, higher lows. But right here, you can see this last move down has neutralized the uptrend in this degree. Okay. Remember, everything is, all the statements we make about starting the uptrend or maintaining the uptrend, all these statements are only valid for a particular degree of movement. That's why when I make the statement that this uptrend in PG has been neutralized, this statement, I have to qualify the statement by saying that this uptrend has been neutralized in this degree of movement. Degree of movement means you can think of it as a zoom level. Okay, so this is a pretty reasonably high level of zooming in. Okay, so this uptrend has been neutralized only at this level of this zoom level, that is this degree of magnification using the 1 hour charts. Okay. These terms also you must completely internalize. These terms are called, this is the granularity, okay? So this is a 1 hour, snapshot frequency. The data is captured once in an hour. This would be 2 hours, this would be 5 minutes. And the term that we use, these are all there in your notes, so I'm not going to write anything or explain anything, but you must be familiar with all these. So this is the granularity factor. Okay. As I reduce the value of the time period, that is, I'm going from 45 minutes to 3 minutes, the time period is actually reducing, but the granularity is increasing. Okay. This is becoming more granular. Granularity comes from the word grain. Okay, so this is becoming more granular, very highly granular. So granularity is increasing. Okay, and the snapshot frequency is actually, the period is reducing, but the granularity is increasing. So this statement is only true for when you say uptrend has been neutralized. You have to also qualify the statement by specifically mentioning the time frame or identifying visually which time frame, which snapshot frequency, which granularity are you looking at, and what time frame are you looking at. This is called the data range. Starting point to ending point. Okay, this is called the data range. All these are given in your notes. When I say notes, I mean here. In these notes are I've given you the set of the important notes for the project. Make sure you internalize all this. Okay, all of this stuff that I'm telling you, you have to revise and keep revising until it becomes second nature to you. You're able to do it in your sleep. So why did I say that the zoom level or the degree of pattern or the pattern size, okay, this is a particular size of pattern. Why is that statement important? Because here you can see this level of detail because it's a 1 hour chart. So you can see higher highs, everything remains higher highs, higher lows until this point when this low is broken. When this low is broken by the decline here, then the pattern of higher highs and higher lows, and in the case of an uptrend, as we said, maintaining an uptrend, you need to maintain the lows. Every low must be higher than the previous low. That condition gets violated, but the statement is only true for this degree of, this pattern size. This pattern size or this degree of movement or this degree of magnification or this degree of zoom, okay? Why do I say that? Let's go back to 5 years, okay? Can you even see any of this stuff that we were looking at earlier? We were zooming into this part. You can't see it because here you notice that the granularity has changed to 1 week. Earlier we were looking at 1 hour data, so this is 1 week granularity. Now the pattern size we are looking at is a much bigger pattern because we are looking at weekly data. So now I can't even see all this stuff. This just looks like a straight line to me, okay? We don't look at this small thing here because it takes too much effort. When we look at a degree of movement, we just look at the broad patterns we can see. So here we would just see 1, 2, and 3. Okay? So this third wave here, okay, these are called waves. I'm going to keep referring to these as waves. Down wave, up wave, okay? That's why I also said it's like surfing. Okay? There are more reasons for that as to why it's like surfing. It's exactly like that because you have to develop a feel for the patterns. So that's why I said that statement which I made earlier in the previous Zoom level, that the small break of the uptrend here, that statement was only true for that 1 hour granularity chart. It is not true for this statement, this chart which has a 1 week granularity because I can't even see all that level of detail. So what we know is if you zoom in inside this, there's a pattern, there is an uptrend which has been neutralized. But when I look at the broad uptrend on a much bigger pattern size, which is up, down, up only, here there is no neutralization because the higher highs, this one high then was broken as soon as we made a new high. So this is a new high here ultimately. But the uptrend developed as soon as we broke above this. As we came above here, we broke above this high, the uptrend was established. You had a low and you had a higher low. And we don't see a break in, we don't see a neutralization of this larger uptrend. So this is also very important. This brings us to the point which I made earlier, but once again, I want to get you guys into this. So you see the larger degree uptrend, the bigger pattern size, okay? I'm going to just start calling it big pattern. This is the big pattern and this is the small pattern, okay? This is a small pattern, 1 hour chart. That was 1 week, that was, this is 1 hour. This is a small pattern. I'm going to say big pattern, small pattern. So that's what I mean when I talk about this. So here you can see that there is a break of the uptrend. Okay, the maintenance, the condition for maintaining the uptrend has been violated. So there is a neutralization of this uptrend. So if you see here, what I just explained here, I'm repeating a lot of this stuff because I want to make sure everybody understands this way of looking at markets. Very, very important for the kind of very basic trend, very basic TA system that I'm trying to teach you right now, okay? So, if you see here, I have made a statement, this one, neutralization on any given degree of magnification. You can read the statement, okay? All right, now, so if you have neutralization in 1 degree, does not necessarily mean that the next degree uptrend, downtrend will also be neutralized. What do I mean by this statement? Exactly what I just showed you. That when you look at PG on this time frame, okay, this pattern size, small pattern uptrend is neutralized, okay? So we are around 136. Small pattern uptrend is neutralized. It happened on, say, around 4th of September, okay, when this low was broken after making a new high. Then this low was broken. Okay, so you no longer have higher lows. You have a lower low. This low is lower than this low. So the condition is broken. Uptrend is neutralized. However, because this uptrend is neutralized, we are on 4th of September, we are at 136. That does not mean that this larger uptrend, big pattern uptrend, small pattern uptrend is neutralized. But that does not necessarily mean that the big pattern uptrend is also going to be neutralized. Okay, it may be or it may not be. So there is no, because of this small pattern being broken, you can't assume that this will necessarily break. It might break or it might not break. Okay, so the guy who is a momentum player, who's playing the momentum strategy on this larger pattern, that fellow will still be wanting to buy, because on the larger pattern he sees a continuing uptrend and he does not see neutralization of the uptrend. Okay, so he will continue to have a buying bias. So he will say, therefore, if so this larger pattern, instead of using 1 year and 3 months, we'll use the 3 particular patterns we looked at. So he will continue to have a buying bias, but he will say that, okay, I think this is going to continue to go up. But when he zooms in to his small pattern, remember I told you to look at 1 year and 3 months, and we are looking at slightly two different, around 5 years and slightly more than 3 months, just to capture the entire movement of this, last part of the trend. So this guy looks at a big pattern is up, small pattern is also up, but there is a small problem here, because the small pattern is up, but the uptrend on the small pattern has been neutralized. Okay, so there is no buy signal at this point on the small pattern, but he maintains a buying bias because the big pattern is up and the small pattern is also up. But he's watching, but he's not going to enter right now, okay? Because the small pattern is up, yes, but if you zoom inside the small pattern, the uptrend has actually been neutralized. When you look at from here to here, the uptrend has been neutralized, so there is no buy signal here. But because the bigger pattern is up, okay, he is looking to buy, but he is not able to buy right now, because when he looks inside the small pattern, he sees that the uptrend, the smaller uptrend has been neutralized, so there is no buy signal right now. Okay, so that's what we meant, that because this has been neutralized doesn't mean that the other one, the big pattern, will also be neutralized. So he's still looking to buy. As soon as he gets a buy signal on this pattern, he will go long, right? That's what he's going to do. So this is what we are discussing. We're trying to establish a TA system, which you can use, a simple TA system. So what we would do is, I had written something here. Yeah, I'm going to copy this also and put it into a simple trading system. Okay, we will take some of this stuff and we will put this so that it all remains in one. So this has, I'm just taking this will appear in 2 places. I want to make sure that when you start looking at minimum condition for starting uptrends and downtrends, that there is a direct implication for and we'll take this also. There is a direct implication for solving the DP4 problem based on the minimum condition for starting uptrends and downtrends, which we discussed in the previous class. So I'm putting it into the trading system note also. And then the other point, which is minimum condition for maintaining uptrends and downtrends, that also has an implication, and that also we will put into the same note, which this has all been discussed in the last class, and this is where we were actually towards the end of the last class. Yeah, so this we explained in great detail. Okay, so I'm not going to go into that. You can look at the video. And so once again, I'm repeating that you are supposed to be looking at all the notes and making sure you understand everything, and it's your responsibility to tell me and ask questions. When you don't understand something, then I will explain the note. Maybe I'll write a little bit better. I'll clarify something. So you have to keep reading all the stuff and make sure you understand everything that has been discussed. If you don't ask questions, then I assume that you've understood everything. So this also we are putting into the trading system note, what we discussed the other day, which is implications for exit price with loss. Okay, when you're looking at this principle, when you look at this principle, what are the minimum conditions for maintaining uptrends, downtrends? There is a direct implication for how to decide how to solve this DP, which we discussed in the last class. Basically, what we said was that because the condition for maintaining uptrends, and we are only discussing uptrends right now. We can flip it around for downtrends. Condition for discussing for maintaining uptrends is continuous higher lows. Subsequent lows must be higher. And when we say low, we mean lows from which a new high is made. Okay. Now, because these are going to be higher in order to maintain an uptrend, and here we see that the downtrend, uptrend is neutralized. That's so anybody who had gone long at this point, okay, as a new uptrend, as the uptrend continued, okay, or anybody who was long even from earlier, his stop on the long position, his stop, that is exit price with loss, okay, will necessarily be here, okay, because this is the point which, if it is broken, if the price goes below this, then the condition of higher lows is no longer maintained. And so the long position was being maintained. So what is the logic for this? I told you many times that when you go long, this should be your stop. When you go short, if you take any short position stock, if you take, let's say, just the last decline in Tesla, right? If we take a very small so if you have gone long, if you have gone short in Tesla, then your stop would be, if you've gone short, let's say, just looking at the very short term downtrend, then your stop would probably be over here. If you look at this small pattern size, or maybe at the worst, it would be here, because this is the downtrend, and as soon as either this or this is broken, the downtrend, that is the pattern of lower highs, and so for maintaining a downtrend, you need to look at the highs condition. So lower highs, if it goes above this or this, the pattern of lower highs is destroyed. So why did you go short? Because you thought there was a downtrend, okay? And why did you? And so if you thought there was a downtrend and you were a momentum player, you thought the downtrend would continue. The reason that the logical stop for your position, okay, the logical solution to DP 6.2 using TA, not FA but TA. The logical stop is here is because beyond this point, the condition for maintaining the downtrend is violated, and because your short position is based on the assumption of a continuing downtrend, when the condition for maintaining the downtrend is violated, your assumption of a continuing downtrend is also destroyed. So when you did something that is going short based on a certain assumption of a continuing downtrend, when that assumption is destroyed, you should also logically you should try to reverse what you did if it's possible, which is possible in this case. That is. So this is what we discussed, okay? So a very important point. We can maybe go back to our old point of old ticker of FCX. So this is what we discussed. Okay, so I'm just putting all of this into the simple trading system. These are very important points to discuss. So that now, so if you see now, we have a very simple, just to recap at this point, we have a, just take a second. Right. So we are trying to construct a simple trading system using TA, because here we are, we have looked at these two approaches. Now we are within TA. We were looking at the differences. We went from cyclicality of market prices, very important topic. And from there we have, while discussing that, we are constructing the principles of a simple trading system using TA. Right. So where was I? Okay, so solving a DP4, yeah. So what we'll do is we'll go back to this idea of the two time frames, as we said. I'm just recapping once again. Two time frames. We look at FCX. These are the time frames I have given you: 1 year and 3 months. Okay. Now, as I said in the last class, please remember that although I release the class, if anybody is asking a question, that gets captured on video. And so therefore, as far as the syllabus is concerned, or what you need to learn is concerned, the discussion I have with the person at the end of the class, that's also part of our syllabus, okay, our coverage. So like, so she asked a question the other day, and I explained to her. So that all that is captured on video, that becomes part of our discussion. Okay. So now she was talking about different time frames actually. And so, as I mentioned, I've given you 1 year and 3 months just to, give you something if you're not able to decide. But you don't have to stick to this for your project. You can decide, for instance, that this stuff is too long for me, which is quite reasonable because the project is very short duration. It's a very short duration project. So you could decide, okay, which is, you could decide that maybe this is too big, this is too sort of too long term for me. So I'm going to use only 1 month. Okay, I'm going to use only 1 month and 15 days. You can do that as well. Okay? It's not 5 days, but 15 days. So you can maybe start using you can use it through, you don't have to do it through this thing. This is very easy, makes it very precise. Otherwise, there is another way for you to do it, which is to choose a granularity with a 1 hour chart. Keep scrolling out, using the scroll bar, scroll button on your mouse. You can just scroll out and get a maximum display. Maximum display means here the total number of the full data range is being shown, maximum number of records that this software can display. So you can just take this and you can, from here, you can see what the 1 month trend is. Okay. When you look at the 1 month trend, you can see what it is here. Then you can just look at this chart and decide, okay, today is the 12th of September. So 1 month must be 12th of August, okay, roughly 10th of August, and it must be around here. Okay. So from here, you can see already what the 1 month trend is. And then the 15-day trend. So you see the 1 month trend is up, and the 15-day trend, if you want to look at, you can maybe look at a 15-minute chart. And you can see the 15-day trend would be roughly towards, let's say, 24th or 25th August. So you have August 3rd, somewhere around here. So that's also up. Okay. So you can see now this is a very short-term pattern. So if you see, these are very short-term patterns. So you can also choose any other pattern size that you want, because that will help you to maybe get more signals, because your project time frame is very short. Okay. So you can also use 1 month and 15 days. I'm just giving you another example. Now, the reason I'm giving you two time frames, let me just come back to this. Okay, let me write this here. We can write it, maybe I can write it here. Why am I using two time frames? Time frame is the same as, I sometimes I call it a two screen system. The screen is shorter than, it's a shorter word here than this one. It's the same as time frame, is the same as pattern size. It's the same as, you can call them two different systems actually. But we'll not call them two different systems because we're talking about a trading system. I would say screen or pattern size or time frame. Okay, now why two time frames? Let me explain why that is. That is also connected to, so this may be actually a point. Why two screen or two time frame? And this two can, or multiple time frames. Okay. So I've just given an example of two, but it need not be two. It can be even multiple time frames. You could look at, like for instance, we had discussed some of the Wander charts, which I'm pulling up now. So the question is, why two? Why not just one? Why should I not just look at FCX? Go back to my own earlier system, 3 months. Why not just look at a 3-month time frame, the data range with a 1 hour granularity? Okay. Why not just look at this? Why should I bother with 1 year? Okay. Why should I bother with this larger, with the big pattern when I can just look at 3 months? Okay. Why not just look at the small pattern? So the answer to that is because if you remember, one of the other important properties of cycles that we studied when we looked at cyclicality, one of the properties was smaller cycles are constrained by larger cycles. So what we meant by that was that there is a sequence, the smaller cycles are just tracing out the uptrends and downtrends within the larger cycle. So therefore, when you look at, we looked at in particular, what we looked at was, if we go and launch our Yahoo Finance chart. So the principle that leads us to use at least two time frames, and you can use multiple, is because when you, this principle of smaller cycles constrained by larger cycles. So when you, what we meant was that when you look at this larger cycle, up, down, low to low cycle, 8 years, okay, and you look at the smaller cycles within the uptrend portion of the larger cycle. When they go up here, they're coming down, but they're not coming down as all the way up to here. Again, goes up, comes down, but not all the way up to here. Okay? Again, goes down, but not all the way up to here. That's why you get the pattern of higher lows. So why is this happening? Because the larger trend is an uptrend, this big move from here to here. So therefore, this declines can't come all the way down because they have to maintain the net uptrend. So that's why we look at two time frames at least, because we want to use a big pattern also. In the two time frame setup, we will call it big pattern and small pattern in order to use very short words. This is the big pattern, just up, down. Small pattern is all these little up, down, up, down, up, down, up, down. Okay. So the reason we use two is we don't want to get lost like here. We don't want to just look at this and say, oh yeah, great, this is the downtrend, let me go short. If we do that, if I only look at this kind of pattern size and I don't look at the bigger picture, what is happening is I am getting swayed by this short-term downtrend, and I'm not able to see the fact that this is actually just a small decline in a larger uptrend, and that because the smaller cycle is constrained by the larger cycle, okay, until the larger cycle itself turns, which is at this point when this low is broken decisively, then you have a turn in the larger cycle because the pattern of higher lows is broken. But until that has happened, at this point, if I get excited and say, great, I've got a downtrend, let me go short, I'm being a little foolish because I'm failing to see that because the principle, because of that principle, the smaller cycles are constrained by larger cycles. This downtrend does not have much potential for moving down because it must maintain the net uptrend. Okay, so that's why we don't want to get swayed by just looking at the small pattern, small pattern size. We want to look at both the both the big pattern and the small pattern. Okay, and that's why I gave you this rule. And this, I have given you the example only with two patterns, but as I said, you can this two can be made into, instead of two screens, you can talk about multiple screens. Now, what do I mean by multiple screens? This is what I mean. If I show you Wanda, you can look at, let's say we are here, we are looking at the euro, okay, which is very big pattern here, big pattern size, and zooming in all the way here, you can't even see anything here. This zooming in continuously, and here, this last one is very small pattern size, okay, 5-minute granularity. Here the granularity is 1 month, and here the granularity is 5 minutes. So this actually is the zoom in of really small, really high zoom in over here, okay, which you can't see here on this chart. But these are multiple time frames. The data range keeps getting smaller. Okay, as you move like this, the data range keeps getting smaller as you move from here to here. So this is an example of a multiple time frame chart. And as I told you, the ideal way, this was in response to Vipul's question, that the ideal way to look at charts is if you have no constraints whatsoever. If somebody came and said, okay, tell me what kind of trading software you want me to build, charting software, and you're giving him the specifications, this is what you should tell him, that I should be able to look at anything, okay? Instead of Euro USD, I should be able to look at maybe oil. Are they not showing oil here? Yeah. So if I want oil, I can just take oil. I should be able to look at any market, any instrument, okay? And I should be able to get this kind of display. Very high zoom out, very high zoom in here, and in between all the things. And this is the ideal way of looking at charts, multiple time frames. But in real life, you may not have the software that you are, maybe you have bought, does not have facilities like that, can't display all the markets. So those are constraints, but I'm just telling you what you should be looking at ideally. So this is an important point. Why two screen or two screen or two time frame? Because of this important principle that smaller cycles are constrained. You have to understand how the rules that I'm giving you use two screens at least. Why did I say that? Because of this important theoretical principle which we have discussed in the note, that smaller price cycles are constrained by the uptrend bias of uptrend downtrend bias of larger cycles. So we want to capture, actually what we want to do is we want to capture the movement of the big trends, okay? And but at the same time, so this is when we talk about profits. When we talk about profits, okay, and is exit with profit, we want to capture these big profits which will come from capturing the big moves. But when it comes to risk, okay, what will be our 6.2, that is exit with loss? When it comes to risk, we don't want to use big pattern stops. Okay, we want to look at small patterns, like say I'm going long as the market makes a new high here. I want to put my stop here, okay, so that it's not too far away and I'm not losing too much money per unit. Okay, that's another reason I look at the small patterns, the main reason for setting my stops. So when I talk about how much profit am I trying to make, what kind of profit am I trying to capture, my focus is on the big pattern. But when I'm talking about uh, where do I want to put my stop, my focus is on the small pattern, okay, which is DP 6.2 exit with loss. So I will go long here as a new uptrend develops, or I can actually go long here itself because I can see that there is an uptrend, low, higher, low, higher, low, high, higher, high, higher, high. So as a momentum trader, I can go long here itself. And but if I go long here, my stop would have to be here. And a better way to do it with the shorter stop is as soon as a new high is made, okay, new uptrend continuing, and then you have a new higher low figure, higher low mark where a higher low from which a new high is made, and you can put the stop here. So this is the value of the smaller pattern, the small pattern. Why does the small pattern, why do we look at the small pattern? For setting our stops, okay? So remember, this is called the stop part, okay? Exit price with loss. Although in layman's terms, we say stop loss, but in terms of the technical language of the system, we say stop only, not stop loss. Okay, and the reason for that, I'll just briefly explain why stop only, why not stop loss, is if you look at now here in FCX, now let's assume that Sachin had gone long here itself, 1060 or 1040. He had gone long here itself, and initially he had put the stop here. Now, as the market keeps rising, okay, initially put a stop here because, so if Sachin went long here, let's say, and so let's say 11.5 or something, or the new uptrend is made, he goes long here and puts the stop logically here, because this is the, at this point, all this has not happened. We don't know all this stuff. He just goes long at this point as soon as a new high is made. This high is crossed, new high is made, it goes long. At this point, what is the, so he will ask himself when he goes long to set his stop in order to solve the exit price with loss problem. Where should I put my stop? He will ask himself, where is, which is the highest low in this trend, which is the highest low from which a new from which a new high was made. The highest low from which a new high was made. Visually, you understand. In English, it sounds confusing. And the answer to that is here. Okay, so he goes long here and puts his stop here, because after he goes long, if the market drops below this, then the condition for maintaining the uptrend will be violated, and the assumption based on which he went long, that is also destroyed. So he should exit. So he puts the stop here. Okay. So what we are saying, what we are talking about now actually is why we use the term stop and not stop, stop now and not stop loss. I want to put this into the actual note so that we make sure that I want to put this into the actual note of 6.2 solutions, okay? So that we have the okay, so we'll put in the other because we have not had a detailed discussion of this, but what we have discussed here, for instance, example as a long position. Okay. Well, At point means, when I say at point, what I mean is when Sachin goes long here, he puts the stop here. That means actually the way he will do it is he will read off. We're not going to waste that time here. You can read off the values over here if you focus. What he will do is he will find out, he's talking about this low here actually, right? So what he's going to do is actually he's going to slowly move the cursor. As you can see, as I move the cursor, these numbers are changing. Okay. So he's going to slowly move the cursor and find out exactly what the low is. Okay. So let's say the low is 9.7. Okay, the actual low. So his condition is, what he wants to tell the system is that as soon as this low is broken, so if 9.7 is the low, you can put 9.69, okay, because we have 1 cent tick size. So he finds out that the low is 9.7, then he puts the stop at 9.69. If you remember, when you put stop orders, you need to put a trigger price, 9.69. And then the system will monitor. As soon as the market trades at 9.69, it will sell off his position. Okay. So, what was I saying? Right? Put a stop at point. Okay, so that when I say put a stop at this point, actually this point is 9.7, but strictly speaking, what he will do is just below this point. Okay, so when I say at point, it's just below. Okay, at point. Example is a long position. Okay, so put stop at which point? Let's put it this way. Let's put it at which point. This is also important for your learning as to where you put your stop. Okay. Now this is very important that for any pattern size, or I'm going to use this colloquial language of zoom level. Zoom level means, imagine Ethan is using his camera, zooming in, zooming out. Okay, so degree of magnification. If you want to use a bigger term, you can use degree of magnification. Okay, pattern size or zoom level. For any, so important to understand any statement I'm making, like here, Sachin is going long, pulling this, because he's looking at this pattern size. Pattern size is affected by the granularity. Okay, if you suddenly make this one, instead of 1 hour, you make it 1 week, you may not even be able to see this low because it's too small. Maybe it won't show up on the 1 week charts. So when I say all these things, put a stop at which point, these statements are all apply for any pattern size or zoom level. That means you have to lock in this pattern size or zoom level and then talk about all these things. Okay. So at which point will you put the stop when you go long? The highest low from which a new high was made. Okay. Now this is the English part of it, but it's easier to remember. We need to write the English part of it also so that we have the theory on paper. But visually, it's much easier to remember. What is his goal as he's going long in an uptrend? He goes long at this point because this is marking the continuation of the uptrend. And as he goes long, what is his condition for maintaining the uptrend? This one, because low, higher, low, higher, low, all higher lows, new high, highest low. So as he goes along at this point, this is the critical point. If the market drops back below this, then the condition for maintaining the uptrend is destroyed. And when you put it into English, what is that condition? What is that point? The highest, remember we are here now. We don't know all this stuff has not yet happened. When we are here, this low is the highest low from which a new high was made. Okay, and that means this is the point which maintains the uptrend. Okay? So obviously I'm giving you the logic for an uptrend. You have to flip it around for a downtrend. Okay? I'm not repeating the downtrend logic, but that does not mean that you have to always be a buyer. I'm just giving you the example from the long side. Right? So this is what it means. All right. And now, what is the reason why I went to this? Okay, I want to basically explain this point. This is also important for you to understand. We will do this later on a little also when we look at DP5 solutions, but let's understand it right now. That why do I say that this is layman's terminology? When you look at the IB system or any good trading system software, look at any good trading software, they will not use the word stop loss order. They will use the word stop order. Why? And the reason is, okay, the reason is that, let me put this here once again. So, why stop order? Try to explain, okay? So this is the principle. When you put the stop, that is, when you try to solve your 6.2 exit price with loss, this is the principle when you're using TA, okay? This is the principle that you use, okay? This, which we just explained. Now, so now notice what happens. So Sachin goes long at this point, okay? And at this point, using that principle, he puts a stop over here. Now, when the market has come to this point, let's assume that he does not do any pyramiding. He does not add to his positions as the market keeps going up. Okay, we are assuming that only to keep things simple. Okay. Now, at this point, now he went long here. Now, all this time has passed and we have come to this point. Now, do you think that his stop is still going to be over here? Because what is the principle that we are using? Okay, the highest low, the stop should always be at the highest low from which it can earn. Okay, yeah. So this is basically at any given point of time. Okay, at any point in size, put stop at which point, the highest low from which, and let me clarify this. That is. Or let me write this in a better. The current point of time. So when he put his stop over here, so you have to look at the current point. When he went long here, all this had not happened. So at the current point, when he applied, he asked himself the question, what is the highest low from which a new high was made? Answer to that question was here. Now, when he goes, for this, now when all this time has passed, okay, now what will happen is when he asks the same question, that when he's here, okay, and so as you said, the principle is that at any given point or at the current point of time, you always keep asking yourself this question: what is the goal? The goal is to solve this problem, this DP. What should be my exit price with loss? Okay, that is the goal. How do you solve it? When you're using TA, this is the principle you use, okay? And whatever you can see at the current point of time, which means imagine that you're doing this constantly. Every 10 minutes, you're asking yourself the same question. After 10 minutes, of course, the market has moved a little bit. Okay, so you can do this even after one day. Every day you ask yourself this question, but every day some movement. So the market has changed. So every day he was asking himself this question. And when he asks himself this question today, as you can see, today when he asks himself the question, what is the highest low from which a new high was made? The answer to that question today is no longer this point, right? The answer to that question today is this point, whatever this, let's say it's 15.15, just to be honest, just to round it up. Is everyone clear about this? I hope everybody has understood this. So he will continuously, after going long here, he will continuously ask himself the same question every day. What is the highest low from which a new high was made? As we approach this point, when we are standing here in terms of time, all this has not happened. When we are standing here, the answer to that question is now here. When we are standing here, the answer to that question is here. When we go here, the answer to the question becomes here. Okay, so on and so forth. Okay, is this clear? So this point is that we are discussing the point of how to solve exit price with loss. Very important, the most important decision actually in a trading system. So long position. So how do you solve this? The highest low from which a new high was made. Okay, whatever you can see at the current point of time. Okay, so basically, let me just write it in plain English. So keep asking yourself this question.
Sir, it is highest low or the lowest low? Matlab, it is getting a bit confusing.
That's why, yeah, it's quite natural for it to get confusing. Even I get, if you remember, I made a mistake when I was saying higher, low, higher, lower, high. You know, that's Betty bought a bit of butter, that kind of thing. So always do the visual part, okay? Always, if you are going to define what is the definition of an uptrend, don't write the English. Remember, visually we remember everything clearly, right? Any uptrend will have this kind of sequence. Any downtrend will have this kind of sequence. Doesn't matter what you're looking at, okay? So first draw the chart. If you have pen and paper, if you are on a computer, then you just pull up a chart. Any chart will have this feature. This is a guaranteed feature of every chart, okay? Any chart will have this feature. So first draw the picture, put the visual picture in front of you, and only then you use English very slowly, you speak English very slowly, and state, if you want to state the theory, which you need to do also, because we have to get used to both visual and language, okay? First you do the visual and then you write the theory, okay? So come back to what Utsav is asking. Is it the highest low from which a new high was made? Remember, we are talking about long position, okay? So therefore we are talking about uptrend, okay? We are talking about momentum. So we are applying TA, and within TA we are applying uptrend, implying long position, assuming we have to be clear about everything, assuming momentum trading, okay? All right, put stop at which point? Okay, so this is not looking very pretty, but all the technical points are all there, what we need to have. Let's space it out a little bit, makes it easier to understand, okay? Put stop, yeah. Let's bring this down so that we have, yeah. Now, what Utsav is asking, I have said this. Highest low from which a new high was made. When what Utsav is asking is, should it be highest low or should it be lowest low, etc.? No, it is always the highest low, because if you go back out, zoom out a little bit, we are following this uptrend in FCX, okay? So Sachin, let's say, is a momentum trader. He wants to trade in the direction of the current trend, okay? And so he was not here available. He came back from vacation and he saw the market here. He was not very sure, waited for confirmation of the continuing uptrend. As soon as the market went up, actually here also he can, as a momentum trader, he can buy. But if he buys at this point, then his stop, applying the same logic, highest low from which a new high was made, would be over here. So that, he said, that's too far away. You know, I don't want to go long here at 1044 and have a stop at 704, and that's too big a stop. Number of units lost per trade, is too much. So he doesn't want to do that. He wants to wait. As soon as he sees a new high, okay, let's say it's 1170 or something, he goes long, and now he can put the stop here. This is much closer to his entry point. Okay? It's a shorter stop. So he goes long here. So if you remember now, coming back to some question, what is the question? Because it's also related to, and this point, okay, let's also not lose sight of the principle, okay. Any highest low for put stop at which point, keep asking yourself this question, okay. Why, this we can put in brackets, this is not so important as the principle, okay. We can put it here. Why this principle, okay, or why this rule or principle, okay. This is also connected to what we already discussed here. Minimum condition for maintaining uptrend and downtrend, okay. When will I exit? When will I exit? I will exit when the assumption based on which I entered. I made an entry based on a certain assumption. If that assumption is destroyed, then I should exit if possible. Sometimes in life it's not possible, but in trading it's possible. So if I entered based on a certain assumption, that the assumption is destroyed, I should exit the position that I entered based on the earlier assumption. So that's essentially the condition for maintaining the uptrend. Once, if you have gone long, you're a momentum trader, if the condition for maintaining the uptrend is destroyed, I should exit, okay? So this is why, if we say why this rule or principle, why did I write this rule or principle? Because of this, okay? I'm just going to write this here to make the connection. I'm not going to repeat all the things. Once you, when you see this, you know that you have to go back to the cyclicality note, okay? You have to go back to the note on cyclicality. In fact, maybe what we can do is, we can put the hyperlink, it will take you directly back to that point, okay? So I'm saving you guys a lot of work, okay? So I try to, hopefully it comes up with the hyperlink. No, it doesn't, okay? So it's okay. You should remember where this subtopic comes from, okay? This comes from the cyclicality note. Now, why this rule of principle? As I just explained, you will exit. Now you're deciding an exit position. You're talking about the exit decision problem. Okay. Let me put that also here. This is already the exit decision problem. Okay, 6.2. So why this? Why am I giving you this rule? This is also based on this principle. So every kind of decision rule that we are coming up with is coming from some theoretical principle we already discussed, okay? So very long answer to Utsav's question, but I always give you long answers because I want to make sure that you understand the context, okay? So look at it, okay? What is the principle that maintaining uptrends, okay? 6.2, exit with loss. When will he exit? When the condition for, when the assumption based on which he entered is now no longer, it has been destroyed. At which point is it destroyed? What is the condition for maintaining an uptrend? Because he has gone long as a momentum trader, that means he's assuming that the uptrend is going to continue in the same direction. So what destroys this assumption? When the condition for maintaining the uptrend is destroyed. What is that condition? LT plus 1 is greater than LT at all points of time. That's why I said, keep asking yourself this question. Okay, if you go back and look at the note, condition for maintaining uptrend downtrend is LT plus 1. We'll do it for you here. here for all t. That's why I said this. Keep asking yourself this question. What does this mean? That means you do it at all points of time, constantly. Ideally, if you're a computer, you're doing it second to second. Every second you're doing it. Okay. And so when you look at the condition LT plus 1 greater than LT for all t. Okay. So coming back to Utsav's question, when we apply that condition, what Utsav was saying is, should it be the highest low from which a new high was made, or should it be the lowest low? Obviously, when you look at the visual and you go through all these theoretical principles, we are deciding the exit decision, exit with loss. When do you exit with loss? When the assumption based on which you entered has been destroyed. And what is the assumption? You assume that the uptrend is going to continue. Well, if the condition for maintaining the uptrend is destroyed, then that assumption is also destroyed. What is that condition? LT plus 1 greater than LT for all t. And when you draw the chart, first always do the visual first. Otherwise, you'll get confused. When you draw the chart, you see LT plus 1 higher than LT for all t. Now, at this point, you're over here. Okay. All this has not happened. You're over here. The condition is here. So, and in English terms, in language terms, what is this? When you go along here, in language terms, this is actually the highest low in the context of this trend. Okay, we are only looking at this trend, not this part. But this trend, when we are standing here in time, what is this low, which we have decided should be such and stop when he goes long? What is this low? This is the highest low, because so far when you're standing here, this is the highest low from which a new high was made, which is the English language way of saying LT plus 1 greater than LT plus for all t. Okay, and this is actually the LT plus 1 at this point of time when we are standing here. Okay, so now Utsav, is your question, now you understood why it's highest low, not lowest low?
Yes, sir.
Okay, all right. So very long answer, but I want to make sure that because he's asking the question, that confusion might exist in other people's minds also. And so it's very important to go through I go through a lot of very, very basic stuff because I want to make sure that everybody understands, because this stuff is all new for you guys. And it may be very obvious. Once you start doing it, practicing after 6 months, 1 year, it will seem very simple to you. But I want to make sure that everything is internalized and no step is missed out. Okay, so that's why I go through all the basics in a very, very kind of like baby steps, because because foundations are very important. My goal here is that I can't teach you everything because I don't have the time. We have only 3 courses. Okay, my goal is to just establish some basic foundational knowledge, make sure the foundation is solid. Okay, that's not easy because many times we find in many batches the foundation is quite weak because the students are not revising enough. Okay, they're not practicing enough. And so my goal is to lay a solid foundation so that on that foundation later on you can build it up on your own. But the foundation has to be solid, right? So this DP4, and now remember why we came to this discussion in the first place, why I started writing in this note. Okay, because I wanted to explain to you why do we stay stop order and not stop loss order in the technical sense. Why stop order? Okay, I'm just going to put this in bold only. Okay, why stop, not stop loss? Here, this is why. So initially Sachin goes long at say 11:45 or say 11:40 at this point, and his stop is at say 9:70 or 9:65 or something, 9:70. At 11:40 he goes long and his stop is at 9:70, because when he goes long at 11:40, he asks himself this question. He says, I am a momentum trader and I'm trading this uptrend, and I have gone long now because I just got confirmation of the continuation of the uptrend. Why is this confirmation? Because higher highs, okay, another higher high was made, and all these lows are higher than each other. Subsequent lows are all higher. LT plus 1 always greater than LT. Now I got one more. If I had any doubt at this time, okay, or I as a momentum trader, I should not have doubt, but here the stop at this point was over here, too far away. I'm looking for a shorter stop, okay. Remember, if he uses a very small pattern, he does not have to use this stop. He can actually use this one. You can see this. When you zoom in here, you can actually see if he wants to use a really short stop. Short means entry price to stop point distance is very small, okay. Very short, narrow stop loss, or short stop loss, or small stop loss. We can usually say small and big. Okay, it's a small stop. He can just go long as soon as a new high is made. This was the previous high, new high. He can even use this stop. Okay, he can even use this one, smaller pattern here. So there are various options. Okay, as I said, it's answer to Srishti's question at the end of the last class. There is no right answer here as to what is the time frame pattern size that you should use. But once you lock into your minimum pattern size, you should no longer change it in the middle of your trading activity. So multiple options exist, but for the moment we are assuming this one. Okay, so we are trying to establish why do we use the expression stop order in the technical sense in the trading system, in the trading software, and not stop loss order, which we use in layman's terms. When we talk in layman's terms, we say stop order. Why? Because when Sachin goes long here, the answer to his question, what is the highest low from which a new high was made, is over here. So he puts the stop here. So 1140 he goes long and the stop is at 9.7. Yes, if after he goes long, if the market were to straight away drop below 9.7, he will suffer a loss. Okay, suppose it drops straight to 8.2 or something. He will suffer a loss because he has entered at 11.4 and he will exit at 9.7. Okay, he bought at 11.4 and sold at 9.7, so there is a loss. Okay, but that's not what happens after he goes long. Market keeps moving up, and remember, all the time he's asking himself like a computer. Every second he's asking himself this question: what is at this point of time, on this chart, on this visual, at this point of time, what is the highest low from which a new high was made? So initially the answer is here. But when he comes here, the answer is no longer this, the answer is this. When he comes here, the answer is no longer this, but this. So your stop has to always be at this point, which is the answer to this question. Okay. So your stop should always be at this point. Stop. Okay, that is BP 6.2 solution. Okay, should always be at this point. Okay, this point means the point which is the answer to this question, which you have to ask yourself theoretically every second. Okay, obviously in real life, if you're not a computer, you can't do it every second. You do it maybe once, 3-4 times a day. If you're a short-term trader, you'll do it maybe once a day if you're a long-term trader. So, but the point is, ideally, you have to conceptually think of it as every second. Okay. Now, whatever is the answer at any point of time, that should be the point where your stop should be. Okay. So, applying that principle. Now, when it comes here, now Sachin has already moved his stop. It's no longer here. He has moved his stop here. He goes to the TWS. He edits his stop order and he edits the trigger price for the stop order. Okay. It has been changed. He will change it from here and he'll set the stop here. 12.3 or whatever. When it comes here, he will now go and once again edit his stop order, put the stop over here. Now when it comes here, he will edit and put the stop as here. Now when it comes to a new high here, he will edit and put the stop at 1505, let's say. So now, assume now the market drops and drops below 1505 and say Sachin's stop is triggered and his position is sold off at 1505. Now he entered at 1140 and he buys at 1140, sells at 1505. Now obviously, as you can see, he is not suffering a loss because his entry price is 1140 and exit price is 1505 when the market drops below this and the stop is triggered. So this is why we don't say stop loss, okay? Because he has not suffered a loss as such, he has just suffered a stop. He has just executed a stop. So the correct term is actually stop, because you can end up, you might have gone long at a much earlier price, and as you keep moving your stop, okay, that's why we say that you keep moving your stop. So eventually when your stop is triggered, it is still a stop order that is being triggered, but it's not a stop loss as such because he's not really suffering a loss, okay? So that's why this is important to understand why we say stop order, okay? And this, your stop should always be at this point, and stop level, well, not continuously, let's periodically. Another term you need to learn is called a trailing stop, okay? So initially when Utsav is asking Sachin, where is your stop? He'll say here. Then when the market has gone up here, now Utsav is asking Sachin, are you trailing your stop? What he's asking is, essentially, are you still keeping your stop here, or are you trailing your stop to keep moving it? Because now when the market is here, your stop should no longer be here. The stop should be here. So this is called the trailing stop. So we say that Sachin is trailing his stop, which means he's moving it from here, then to here, then to here, then to here, then to here, etc. Trailing means kind of like following, okay? So it's a trailing stop. Why do we say trailing? Because he's following the market. As the market keeps moving, he keeps asking this question, and the answer to the question will sometimes change as we have got, when we reach this point, the answer is now different. It's not this, it's this. So Sachin will say, yes, I'm trailing my stop. Which means I keep asking myself this question and keep moving my stop. So now you see why we say stop, not stop loss, okay? So that's basically this point. That's what an important point. We learned a few things. We revised a lot of these principles, okay? Clarified some confusions. We understood why the technical term is stop, not stop loss. And we understood this new term called trailing stop. So yeah, in order not to interfere with your lunch, as you can see, I always set an alarm exactly at 12:45. Okay, so we'll stop here. We'll continue. Remember that your project starts from tomorrow, so please start trading. So I will be penalizing people who don't trade much, and you're also taking a risk because your batchmates might get ahead of you. So make sure you trade. Maintain some reasonable level of trading activity. Get involved in the project, because this is also mainly about learning. Don't worry about grades. Okay, the main thing is about learning. This is the way to. The more you trade, the more you learn. The more questions that will arise. Okay, so your class is dismissed. If anybody has a question, they can stay back, but the rest of you can go. All right. Any questions?
Sir,
Yeah.
The trading will start from 14th, no?
Correct. From coming Monday.
Yes, sir. Tomorrow is 13th.
Yeah, tomorrow is tomorrow is 13th. Tomorrow Saturday, Sunday markets are closed.
Yes,
So
sir. Exactly.
yeah, when
We will start it from September, 14th September only.
yeah. So that's why usually I start the project on a Monday and I finish on a Friday. Generally, I try to do that. So
Okay, sir.
you will have 5 weeks of trading. Okay, so you can use shorter term patterns than what I've given you 1 month. I gave you 1 year and 3 months this was just an introductory idea just to get you into thinking in terms of two screens. So you can modify that. Maybe you can make it 1 month and 15 days, 1 month and 5 days. Okay. Those things are possible. You can do that. I leave that to you. Basically, all I'm trying to say is the only condition I'm putting on you is don't use just one screen. Use two time frames. Okay. And then what those two time frames are: 1 month, 1 year, 3 months, 1 month, 5 days. That I leave to you. Okay. Yeah. Any other question? So yeah. So your question is answered, right? Yeah. So any other question, guys?
Yes, sir.
Anything else?
No, sir.
Sir,
Thank you, sir.
Yeah. And also remember, please notice that because I did not get an answer from anybody, I have clarified to Manik that these change. Utsav, you're still there?
Yes, sir. I'm here.
Yeah. So the change that you had discussed, this is an administrative matter, but the change that you had discussed in the other class, I have communicated with Manik and I have given him the go ahead. So you will be getting some communication, but I'm giving you guys, everybody, a heads up, whoever's here, the 18 students who are left in the class, that that change that Utsav had talked about towards the end of your course, that change is going to happen. Okay, so Manik will take 2 classes in a row, and I'll have 2 classes in a row. So remember that. Okay. Yeah, go ahead. Next question.
sir, Srishti this side. I'm audible?
Yeah.
Yes, sir. Sir, I wanted to ask that when you covered the concept of liquidity, you mentioned the volatility part. I didn't understand that thing.
One sec. There is some noise, I think, in your background. I couldn't hear the last part. When I covered the concept of what?
Just a second, sir. Just a second. Is it clear now, sir?
Little better. Yeah, much better. Yeah, tell me.
Yeah, sir. I'm saying that when you covered the concept of liquidity,
Liquid. Oh, yeah, yeah. Oh, yeah, yeah. I remember you asked this question. Okay, so we need to cover that.
yes,
So, definition of liquidity. And Siddharth had asked this question about liquidity.
sir, at the end of second session.
So I will just search for this. So Siddharth's question on liquidity. So let's open the note on liquidity. So I'm going to stop reading those. So yeah, what is your question?
Sir, I didn't understand the concept of volatility over here.
The concept of liquidity.
No, I got the concept of liquidity, but I was not able to get the clear picture about the volatility part you mentioned over there.
Okay. So let me explain. So your liquidity. So what we are saying here is that generally the market, the principle we are discussing here is that generally markets which are generally, this is not, that's why you notice I did not just write lower. I wrote generally lower. Okay. Why? This is how you should learn to speak. When you speak about things, especially in the world of business, be very careful about what kind of statements you're making. The reason I wrote generally lower is that it is not always lower. It is lower most of the time, but it is not true that it is always lower. So that's why I will not make a statement like this. In response, Siddharth had also asked this question about the connection between liquidity and volatility. And he was asking whether it is always lower. So in the answer to his question, I did not just say lower. I said generally lower because it is not always lower. Most of the time it is, but there could be exceptions. So therefore, when you write about a situation like this, you must then say it is generally lower. In this situation, if I had just written lower, the answer would be technically incorrect because it is not always lower. So what do we mean by this? Generally, what happens is, what is liquidity? Liquidity essentially, as you can see here, ability to transact large volumes in a market without significantly impacting the price. Okay, so liquidity generally means that high volume, it's a high volume traded market. So you will have less volatility. By volatility, what we mean is this. Volatility is, there are a couple of ways to measure volatility, but you can think of just the one easy way to think of the volatility is the standard deviation of the price. If you just look at if you imagine this as a line chart, and that means it's a time series that you have. Okay? There is a price, and you just take the standard deviation of that. The actual calculation of option volatility is a little more complicated, but conceptually the main idea is standard deviation. So if you take the standard deviation of the price series, okay, you remember SD from your stats classes?
Yes, sir.
Yeah. So you know how to calculate SD. You can put, very easy. You can just take this data and you can
Yes.
enter it into Excel, and you can calculate the SD of the time series. So the one simple way of thinking and connecting it to your stats classes is volatility is measured by standard deviation. That statement needs to be refined a little bit, but for the moment we'll keep it at that. Okay. So higher standard deviation means higher volatility. That is a general principle. Okay.
Yes, sir.
And another way of measuring volatility is, I'll tell you one more trick. Let me make this a daily chart. Easier to understand. Okay. And let me make it maybe 6 months. And I'll make it 6 months and I'll make it a daily chart. Right. Okay. So you can see these things. Can you see that you can see all these bars, right? I can even zoom in more. You can see all these bars, right? So this is actually showing you the trading range. There's another way to measure volatility, that is, I'm trying to just explain volatility to you. So one way you have understood, one way of looking at volatility is to look at the standard deviation of.
Standard deviation.
Okay. Another
Yes,
thing,
sir.
there is a trick here. You can see here, go into indicators, fundamental metrics, indicators and strategies. On this charting system, it's a pretty good charting system for a free system. Click on this. You can look for an indicator called average true range. This one.
Okay.
Look for average true range. This is another way to capture the volatility. Can we make this a little bit? Yeah, I don't want to see it. Yeah, just over display. Drag it down. Okay. Now, what is this average true range? That's another way. So another way of measuring, one is measuring whether volatility is a statistical measure, which is you just take, assuming that these are, this is the line chart. Let's imagine this is the line chart, and just take this price series in a spreadsheet and calculate the standard deviation. That's volatility. Another way of looking at volatility is the high-low, which means look at this one. This bar, the range is quite big. Okay, high and low. Okay, the range is quite big. Whereas
Yes, sir.
if you look at bar here, this one, the one before this, the range is quite low. Can you see that? It's very small.
Yes, sir.
Actually, the width is over here, so the range is still smaller than this. So the range is much bigger here, the range is smaller here. So another way of looking at volatility is, instead of looking at standard deviation, you look at the high-low range. Okay, you look at the high-low range. That's another way of looking at you understood that concept, that on a given day, if there is a huge difference between the high and the low, we say that on that day the volatility is more compared to a day on which there is a much smaller difference between the high and the low. This is clear?
Yes, sir.
So average true rate, you can learn this concept today, is very important indicator to measure volatility. Now, here we are not saying range, we are saying true range. True range is only a differentiator. Basically, the idea is to capture the high and the low. But true range, the only difference is, like, suppose the previous day's low, let's say, was 11.10, 11.1. Okay. The previous day's low was 11.1. The next day's high itself is, let's say, 10. The high itself is 10, which
Yes, sir.
previous day's low and today's high, there is already a $1.1 gap.
Yes, sir.
So and then let's say today's range is from 10 to 8. Okay, and just let's assume 10 to 8. So for today, we say the range of today is 10 to 8. That's $2. Okay, but
Yes, sir.
when we want to calculate the true range for today, we don't just look at the range of today 10 to 8. We also ask ourselves, is there any gap between today's high and the previous day's low, or today's low and the previous day's high, and those kind of things. And then we find that, yeah, previous day's low was actually 11.10 and today's high is 10. So when we say what is the true range for today, we have to add to the 10 minus 8, $2. We have to add the $1.1, which is between the 11.10 low of the previous day and the 10 high of today. You understood my point?
Yes, sir.
So this is now you have learned this new technical indicator called true range, where we don't lose today's true range, we say, is actually $3.1. 3.1 is equal to $2 plus $1.1. $2 is
Yes, sir.
the range for today, and $1.1 is the difference between the previous day's high or low and today's high or low. In this case, the price is lower today, so we look at what was the low the previous day, 11.1, and the high of today is 10. So we calculate this difference also and add it to the true range to calculate the true range. So this is the difference. So you have learned quite a few new things. You have learned how to measure volatility the statistical way using SD of the time
Yes,
series.
sir. Yes, sir.
Volatility in high-low ranges. And one important technical indicator in that, so the basic principle in high-low ranges, we call this high-low volatility, right? We can put all this into your notes. Maybe I'll put this later on into your notes. Different measures of volatility have we discussed. We can look at reducing. In this note itself, we can actually put a little subtopic and learn this. So I can put this, I will put this, I don't want to hold you up because you need to have time to have lunch. So I will add this later on, but basically we can have two ways. One is,
Yes, sir. Standard deviation,
okay, and the second is
average true range.
ranges. Yeah, so don't say high-low ranges, and ATR is a measure of that. Okay,
Yes, yes, sir.
average true range and technical indicator, which is, so that basically what you should learn is the two broad. This is the more conventional method. Okay, when you look at finance textbooks and when you do option trading, which you'll be doing in your next term, when we
Yes,
talk
sir.
volatility, that volatility measure is coming from the SD concept. It's not exactly the SD, but it's a SD concept. Okay, driven by this concept. This concept is slightly different from this concept. Okay? So this high-low ranges is the daily high-low ranges, and you average it, and then you have the average true range. You have understood this, you have learned this concept of range, trading range. So it's high-low volatility. This we call close to close volatility. So SD-based volatility, which we call close to close volatility, because we use closing prices. Close to close.
Yes, sir.
And this we call high-low volatility. High-low using ATR. That is the measure, okay, average true range, which is we call high-low volatility. So there are two, when you discuss volatility, essentially what you've learned in this last part is this we call high-low volatility. These are the two expressions that we use. So when you're discussing volatility with the market participant, he starts talking about volatility. One of the questions you can ask him is, how are you measuring volatility? Are you using a close-to-close volatility kind of measure, or are you using a high-low volatility, high-low range, high-low, let's call it, referred to as high-low volatility, but what we mean is high-low range volatility. Is this clear? So,
Yes, sir.
this average true range, you also learned about a new technical indicator, average. And this is the 14 average true range, which means this is the parameter for this indicator, which means what we have done is we have taken every day's average true range figure and we have done an average of the last 14 days. That's all. ATR 14, 14 parameter value. So if you look at FCX, that means today the value ATR value is coming out to around something I'm not able to read properly on this. It's 0.6, which means if you take the true range of the last 14 days, average true range of the last 14 days, the figure is 0.6, that is 60 cents. On average, a FCX high-low range is around 60 cents, including the gap from the previous day. Is this clear?
Yes, sir.
Okay, so you have learned all this now. Now you can go and have a satisfying lunch. Any other question?
Sir, I had one more question. When we discussed about, just a second. When we have to calculate the maximum trades,
Okay.
can you please open the calc file?
Yeah. Is it useful for y'all this what I have done, putting all the links in one file? Is it useful? You can from launch everything from here. You find this?
Yes, sir.
Okay.
Yes, sir. It was really helpful. Actually, I had to sort all the notes. I just copied all the notes in the Word because it becomes very difficult, like confusing sometimes when we are in the middle of a concept and we have to just hop between the pages and many links. So I just copied everything in a sequence so that it becomes easier for me to study now.
But how are you able to copy it? I thought I had disabled copying on all the notes. Is that
Sir, actually, it becomes very difficult to read on the laptop every time. Already, our screen time is around 8 to 9 hours per day. So, it was not possible for me to read it from the screen.
okay? I don't know. Because these are all these are all my own notes. Which okay. I actually wanted to disable this because I want people to read in Netflix style. So by default, it's actually getting it's things. So anyway, I will have to look at all these notes, and so every time I create a note. So let's go back to this anyway. You are talking about the positions, the maximum risk per trade.
Yes, sir. Sir, my doubt here is that till risk capital amount was fine, but when we came to this projected trades part, I didn't find any logic in this calculations and all.
Yeah. So you are wondering why projected trades is showing as 200. Is
Yes, sir.
that your question?
Yes, sir.
Okay. So in projected number of trades, it's a function of your trading style. It depends on how actively you trade. Okay. So if you are looking, so remember all these calculations, these are mainly done as ex-ante calculations. That's where the main utility lies before the event. Okay. You're planning ahead of time. So
Yes, sir.
what you do is you look at suppose in this project your trading time frame will be 5 weeks. Okay, what you're planning is you're going to be doing 5 trades a day. All right. So 5 weeks means you have per week there are 5 trading days, So you have 25 trading days total. Are you following?
Yes, sir. Yes, sir.
So you will decide now whether you do 5 trades per day or you do 55 per day. That's a function of your individual trading style. If you're a very short-term trader, then many trades per day. If you're a slightly longer-term trader, you will do fewer trades per day. So you need to
Yes.
it may not work out to be correct. It's just an estimate from before. Okay, it's ex ante estimate. So you basically, the way you come up with this is number of trades per day, let's say 5. Okay. Then number of trading days in the period. This one, there is nothing to estimate. This is very clear. Your project, you have 5 weeks. So you have 5 into 5, 25 days. Okay. So if you're doing 5 trades per day and you have 25 days, then your total number of trades is 125. Okay. Is this clear?
Yes, sir.
This is how you come about. So this is the product of two terms: number of trades, number of days in the trading period, which is always known to you, and number of trades per day projected. This is a guess. This is based on your trading style. You make an estimate, but you can control it in the sense that if you have made some plans based on on a projection that you will do 5 trades per day. And if you have already done your 5 trades for the day, right, and you have lost money on all the trades, then in that case, you should not do any more trades. And that you can control. You can always stop from doing any more trades. So you have some control over the number of trades per day also, right? Once you get to the maximum, especially, right? So is this
Yes,
clear?
sir.
So now that your investable capital, risk capital, now that your projected number of trades, and then you have percentage losers. This is an estimate, okay? This is an estimate which we can reduce this, and you don't need 2 decimals here. This is also an estimate, okay? Number of trades per day, this is also an estimate. Investable capital is not an estimate. This risk capital percentage is an estimate. This is an estimate. And this is an estimate, okay? And so we can put this in blue. These are the user input, okay? This is an automatically derived figure which comes from projected number of trades times E38, which is the loss percentage, okay? 38 and 39, right? These two. So this is basically, now is this clear?
Yes, sir.
All right, okay. All right, any other question? So now
No, sir.
maximum number of trades comes because here we are assuming that all my losing trades, 88 losing trades, all of them will come together. My first 88 will all be losing trades. Okay. And so if that happens and I risk, I don't lose more than this amount per trades, then I will not lose more than my 600,000, 600K. So that means I don't wipe out more than my risk capital. I only lose, my loss is equal to my maximum budgeted loss. Clear?
Yes, sir. So, sir, this would be applicable only if the share prices are in the figures we've mentioned above the investable capital.
Yes. So this calculation is not a function of the share prices that we have discussed here. Okay. This is affecting only the calculation of loss per trade, and maximum number of trades. This set of calculations is different. Okay, this is not affected by this calculation is purely a function of what we have put here in this block.
Okay.
Following,
Fine. Yes, sir.
because this calculation is only a function of what you have put in this block, because it's a function only of this figure. Okay, this then the risk capital percentage, number of trades, users, percentage users, and obviously the number is determining this. So this is not a function of this. What happens is when we take, this figure, and we are looking at a particular transaction. Okay, I know that my loss can't be bigger than this per trade. Okay, so now when I'm looking at a particular transaction, I am looking at entering at 14.41, sitting at 12.43. Okay, so my loss per share is this much. So the question is, how many shares can I afford to buy or sell? Okay,
Yes, sir.
this case I'm buying. So remember, when we are discussing here, it's the number of shares, but actually the correct discussion is number of units, more general term. Because you get when you trade currencies, when you trade commodities,
Yes, sir.
bonds, the logic is not different. It's the exact same logic. So obviously, if you're trading currencies, you will no longer say number of shares. You will say number of units. Okay? So if you always say number of units, it's a better term because it's more general. Okay. So number of units, how many units can I buy? This is my plan. Entry at this point, exit loss at this point. Loss per share, unit is this much. Okay.
Yes, sir.
Then the question, I should actually change this since I'm giving you this lecture. PNL per unit, okay, is this. So now the question is, how many units can I afford to buy? Okay. Now for this, I bring in this calculation here. I got this number already. I can't lose more than 6.8. All right. And this is my total PNL, projected PNL. Right? So I will have to keep on, this is okay. This 4.2 is okay because it is under 6.8. Okay. But if I make this like maybe
Okay.
now this becomes the projected loss is almost 30K. I can't do because my maximum loss is 6.8 from the previous calculation. Following.
Yes, sir.
So the
I got it.
is determined by the maximum risk per trade, 6.8. Here.
Yes, sir.
In answering this question, so we have to come back down to maybe 3,000 or something. 3,000 is okay because at 3,000 I lose less than 6.8. Okay.
Yes, sir. Yes, sir.
You can keep on doing, and later on we will learn a way to do this algebraically. We don't have to do trial and error, but at the moment you can do trial and error, and even you can also think about how to do it algebraically. You can do it algebraically, and very close now. 6857 is slightly more actually, so 340 maybe. So it's just about there. So this is the number of units if you do, and you do exactly very close to the maximum risk per trade. Is this clear?
But sir, we'll have to deal in 100 units order loss, no?
So when you see this, what will happen? Very good point actually. Now this is your ideal calculation. Now after
Yes, sir.
the market lot transfer. Now there is no market lot for 40 shares.
Yes, sir.
Get a solution like this, that means you have to take the min of this. You have to basically round it down to 100.
Yes, sir.
So
Yes, sir.
here you have 400 shares.
Yes, sir.
Very good that your brain is working and you're thinking about the market lot and all that. Good. Okay. So any other question?
No, sir. It's clear. Thank you so much.
No problem. So you can enjoy your lunch now. Okay.
Thank you, sir.
I'll end the session now.